What is up? This is the Working Investor. In this video, we're going to talk about the cover call strategy, the ETFs that use the cover call strategy, what the shortcomings are, and new funds that came out that tend to try to mitigate the problem with the cover call strategy and not just to be a sucker for the dividends and actually lose money in total return. By the way, nothing here is financial, tax, legal advice, or any sort of advice. This is purely for fun and entertainment purposes only. Please see all my disclaimers. Let's get into the video. Every single type of strategy has strengths and weaknesses, but there is a very powerful weakness when it comes to the cover call ETF that you have to acknowledge when you get into these funds, and that is called capped upside, which gives you whipsaw risk. Whipsaw is basically when the market goes down. What scares me most as an investor is with a cover call strategy, you basically accept all the downside. You get all the downside move, but you don't get the full ride up. So you don't get the full upside move, but you definitely get to enjoy the whole ride down. And that's the problem with whipsaw, that when do people lose out in the stocks? If you're overall bullish on an underlying, a sector, overall market, whatever it may be, and you see something that has positive drip that goes up and to the right, the worst time is to panic sell and get out, right? It's not about how many times you fall down, it's about how many times you get up. But with the cover call strategy, you don't get that nimbleness and that elasticity to go back up with the market. You go down and you stay down, and those losses become realized, well, not realized tax-wise, but they become in your portfolio a true loss that doesn't get to bounce back up and reverberate with the market. That's called whipsaw. If you don't get hurt in a roller coaster, if you stay in the ride, no matter how scary it is, the roller coaster is working well, but you get killed if you jump off in the middle of the ride. You don't want to jump off the roller coaster in the middle of the ride. You want to be able to ride this up and down through all the hills. And that's my biggest fear personally as an investor, because why would I buy an underlying if I wouldn't be able to understand and withstand the risk of the underlying? But I also want to have the reward. And with the whipsaw, you don't get to realize that reward unless the income offsets it to a meaningful degree. But with a lot of these funds that are coming out, they're taking the most volatile underlyings, and you're not getting a smooth ride. And they're capping your upside. So they go down and then they shoot back up, and then you don't get to go back up. It depends on when they do their strikes and how they roll it and how they do call credit spreads, whatever. But that's the point. Like you see this guy here, he's got the capped upside. Let me show you a couple examples, and then we're going to talk about the three different types of funds that are out there, and there are probably more, that are trying to mitigate that capped upside, that whipsaw, and they're trying to whipsaw in the hiney. So we're going to go ahead and show you some examples with rec shares that's trying to fight the bully of the capped upside. So they have some increased risk and some decreased risk. The increased risk is that they're using leverage, but the decreased risk is they're keeping half the portfolio completely uncapped upside. So here you have a good example from Tesla, which is the underlying, versus Tesla from NavMax, YieldMax, versus TSII, right? So Tesla, since June 4th, when TSII came around, Tesla is only up about 0.5%. Tesla is up, a little less than that. And that's understandable, because if you look at one of the longest cover call out there, look at Naveen from BXMX, and you compare it to the S&P 500. We're going to go back about 10 years because that's what Portfolio Visualize does. You could see here that if you started with 10,000 in each of these accounts, on the left you have the Naveen S&P buy right, one of the OGs out there. At the end of 10 years, you have about 22K versus S&P 500, good old fashioned. You actually 3X, more than 3X, right? Your CAGR, your compound annual growth rate, is better with the S&P 500. Your standard deviation is a little worse, but the best year has a better best year. It definitely has, the Naveen has a smoother ride, but you could see that the Sharpe ratio is better for the S&P 500 overall. So you see that is the flaw with the cover call strategy, and that is to be expected. So yeah, this is pretty reasonable that Tesla, achieved about, almost 3/5 of the total return of the S&P 500. But you see, TSII with this strategy, it does have the extra layer of risk because it has the leverage. But you see, you've definitely surpassed it, many times over with 4.69% total return since around June 4th when it came out. So that's one example. And here's another example of NVIDIA. This is going back since around 5/28/2025, 93 days. So NVIDIA is up total return 29.21%. That's the underlier. NVD, I would say it did a pretty decent job as an option cover call strategy. It basically got almost the entire total return of the underlyings. I would say they did a decent job there. Kudos, I guess. And then NVII, without the capped upside, but it does have the leverage in there built in. That's probably why they surpassed the NVIDIA. Just so you know, there is Roundhill out there. Everyone's crazy about Roundhill, and I understand they're crazy about it. But the Roundhill fund, people are obsessed with it, but it doesn't do any option overlay. It's just a leverage play, and they're giving you your money back. They do swap agreements, but they're not doing any special type of writing of options. We'll see over the long course which one will beat which one. Is it just pure leverage versus some option overlay with some cover calls, especially when the market's chopping? But that's for a different time. Now I'm going to show you guys Blox. It's a whole different type of strategy that they're doing, that they're trying to overcome the capped upside. So like I said, I have a video on this, but basically they have exposure to Bitcoin and Ether. They have exposure to crypto companies that, are in the ecosystem of crypto, and they provide a weekly income. The way they do it is they don't just give you your return and give it back to you like Roundhill does. They actually do option trading. And the way they do option trading is that they own all the underlyings. They have like some kind of exposure to Bitcoin and Ether. And so they're long all these positions. And what they do is they do put credit spreads and call credit spreads. The put credit spreads is on the crypto industry companies, and the call credit spreads are on Bitcoin and Ether. I know this because I listened to several interviews and they explain it, how they do it. And I looked at their prospectus and their holdings, and that's what I've noticed on that. I'm going to show you in a moment my little sketch here of the strengths and weaknesses of it. But look at this chart, how they're dominating it. This strategy is a killer strategy. Look at Bitcoin versus YBTC, which is your cover call ETF on Bitcoin exposure, versus LeftG, which is supposed to do a lot of stuff, but it's done mostly just cover calls and synthetic cover calls, whatever. They change things up around a little bit. I have a whole video on them. Not happy with it. And then I have versus Blox, which is like my powerhouse over here. So Bitcoin US dollar, I'm going back since Blox came out. And Bitcoin US dollar is up 3.37%. That's so Bitcoin's up 3.37%. The cover call strategy actually did a little better. I have to say YBTC outperformed, which is very shocking, which is great. That's awesome in my books that it outperformed. The underlying is a cover call strategy. Kudos. LFGY, okay, it also outperformed in this period of time, 4.45% in total return. But Blox, my God, Blox is killing it. They're like literally making laps around Bitcoin and everyone else, and they're really, really, really killing it. So with Blox, right? So they own all the underlyings. They're long everything. So that means that you get to enjoy, obviously, just like with the cover call strategy, if the underlying goes down, you go down. So in Blox, just the same. If the underlying goes down, you go down, but pay attention. So they do the put credit spreads on the equity sides of things. So the crypto side of things will not be challenged. The equity side of things, the SP means short put and LP means long put, right? So this spread, between these two lines, the red and the green line, right? So if the market goes down, you go down 1-to-1, but you would also appreciate this extra loss that you have between these spreads. But some of that loss can be made up with the call credit spreads, because when you have a put credit spread and a call credit spread, we call that an iron condor. But this is kind of like an iron condor on the sector, sort of, So if if the equities are going down, chances are that Bitcoin and Ethereum are going down. Chances are they're very correlated, not always necessary, but that means you can only, so that means the call credit spreads will not be challenged, and these will be completely, they would capture the entire dividend, and that may offset some of this extra loss. But you do appreciate the full loss of the underlying plus extra, but that extra may be mitigated, maybe, right? And then the way the strategy works on the upside, if Bitcoin, Ethereum, or the underlying equities really bounce up and go up hard, let's say it goes so high up, it blasts through the short call, and then it continues going up, and then it blasts through the long call, right? They're going to be this little gap right here. They're going to miss out on this little bit of profit. So let's say it's a 3% spread and Bitcoin shoots up past this 3%. They're going to make all the upside until the short call. They're going to miss out on this 3% spread, just for example's sake. But then once it goes past that long call, they have a tail end where a tailwind, I think what they call it, that they continue making more money. So you're just missing this little gap. The question is this little gap that you lose, you did make income from selling the spread, the call credit spread. So that may make up for some of that gap. Plus, the put credit spread on, and this is on Ethereum and Bitcoin exposure, but the equity size of things, chances are they're correlated, not necessarily, but then the put credit spread, the short put, long put, that spread, that also brings in more premium, and that premium plus this premium may mitigate some of that missed upside. But then on the, we're talking about Ethereum and Bitcoin, but and then the rest they get to capture. Plus, whether the equities are going up, they're going to capture unopposed upside from the equity. So I like how this strategy works. Now, we didn't talk about a scenario if it's neutral. Let's say it stays between, let's say everything is kind of very, very flat or like mildly choppy, and it stays between the short put on the equity side and the short call on the crypto Ethereum side, right? It stays within this range. That means that if you had Bitcoin, or Ethereum or these companies, you'd kind of not really make anything or lose much. You kind of be in that little area. But because they have the two types of spreads, two sources of income, short, the put credit spread on the bottom and the call credit spread on top, you're getting double premium while the market is just sitting flat. So I like it that it's a very high win. I like this type of profile. Now, if you guys follow me on X, this guy, ETF Heresy, I definitely give him a lot of credit for posting this. There's a new type of ETF suite, looks like coming out. It's called Income Blast ETF. I think it's by Turtle Capital Agenic. Well, Turtle Capital, that's what it's called. And they have all these types of ETFs coming out. And why am I talking about this here? Because they're doing synthetic long position, and then they also are going to give you weekly income. You still get a weekly income via put credit spread. That's, near the money put, so basically they're giving you long position, and you can go ahead. The guy I have in my Discord, I posted some of these links, but you could look at the prospectus. And this is only a preliminary prospectus. It's not set in stone, so just take that with a grain of salt. And they filed it, I think, August 27th to the SEC. So you may not see it come out till around November 10th, maybe later at the earliest. It doesn't mean necessarily they're going to launch it, even if they get the approval. That's up to the discretion of the fund. But basically, it sounds a lot like the lightning bolt spread, where you have long position and you have put credit spreads. And I just want to highlight this first sentence. I'm sorry it's a little small, but I'll read it out for you. The fund seeks to achieve economic exposure approximating 100% of the upside performance before fees and expenses of common stock of the strategy. AKA, they don't want to cap your upside. So they're going to give you that full, type of upside capture. And if you look way in the bottom, they talk about the fund they probably may own the underlying, or they may utilize deep in the money call options. So deep in the money call options to give you that long exposure. So you have Income Blast by Turtle trying to pop up and punch up that capped upside bully over here. So you have three players: Income Blast, Blox, RecShares, three players, three different strategies. This is long position, put credit spread. By the way, Defiant said they're going to come out with that like a long time ago. I thought they're going to come out with it in April. They never, I don't think they ever did. So kudos to Turtle for just like beating the turtle beats the race, the turtle versus the hare story. Hopefully they come out, but at least another player is coming out with that. And then you have the Blox that does this type of iron condor type of strategy-ish, on mix of equities and, the crypto. And then you got the Defiance, which has its own type of risk flavor with the leverage, but they do 50% uncapped upside. They seem to be doing well. So three different contenders out there. And this one says it'll pay weekly. Blox pays weekly, and the RecShares pay weekly. So you can have a weekly paying ETF. So for those people who are like dopamine addicts and they really want to get that hit every single week of that income, well, you got your income, but you're not getting unhealthy food and eating into your NAV. I'm not saying cover call strategies are bad. As you saw, they do a decent job. They actually help smoothen out volatility sometimes when the market's flat or going down ever so slightly. There are some risks associated with it. I don't like to have my entire portfolio personally in a cover call strategy fund. Not everything has to be cover call strategy. And there hasn't been too many contenders out there that don't give you any other option, or I should say choices, to get that high dividend and to get that weekly income. And I don't, and unfortunately I had to you kind of had to bite the bullet and just go with only cover call strategies. But you have other contenders out there where you could have some, I'm not saying you should do this, but I feel like I can have some cover call strategies, but I can have some that are not cover call, or maybe a lot that are not cover call. And I do like that they have some hedging involved in there, with extra income and everything. Anyways, guys, it's very exciting times. A lot of different choices out there to choose from that give you that great income potential, give you that weekly income, and you don't have to sacrifice your capped upside whipsaw, but you have other risks there as well. But I feel like it's an exciting time to be a retail investor. This is the Work Investor Overnight. I hope you guys have a wonderful weekend and trading week. Be well.